Hey, what's up, everybody? Welcome back to Investing Sucks, and welcome to the fourth installment of the Your Company, My Analysis series. So, this is a series where you guys recommend a company for me to look at, and then we do a deep dive and try and determine if it's a company that's worth doing some more research on and potentially investing in. And today we're going to be looking at Sleep Country. This was one that a subscriber mentioned, and I thought it'd be an interesting look because it is a very recognizable brand, and the business itself is quite easy to understand, in my opinion. And there are some rather interesting characteristics about this business that we'll get into. So what we do in this video is we look at the company, we define who the company is, how they make money. We look at the industry as well. We take a look at their financial statements to kind of understand how the business is done from an operating level and a financial solvency level. And then we conclude the video by doing an actual discounted cash flow analysis to see what kind of value the company provides. So in terms of Sleep Country, it's a pretty easy business to understand. They basically are just a retailer of mattresses, mainly mattresses, but also bedding related products. So they've been around for about 20 or 30 years. They are a very recognizable brand. I think most people in Canada would know who Sleep Country is. And the key point to keep in mind is they are just a retailer. So they don't manufacture or produce anything really. They just buy and sell the mattresses and the other bedding related products. So because of that, you can imagine things like marketing and branding, location of their physical stores, their online e-commerce presence, which is something significant we'll get into, also the convenience, the shopping experience that they provide. All those become really important because that's really how they're going to differentiate themselves versus all the other competitors that are in this market. And how they become perceived by the average customer is really important, and also how accessible they are to the average customer. So real estate, where they have their stores, that's another very important thing. So we're going to get into all that in this video. The first thing I want to look at is the actual valuation multiples for this company. So I'll go to the valuation tab here. This is something that is it's one of the first things I look at because I want to understand how a company is valued relative to its fundamentals going back however many years available, really. So I look at the price to sales. Some people don't like the price to sales, but personally, I think if you look at the price to sales ratio for an individual company, not comparing it to other companies, but just an individual company, and go back many years, say 5, 10 years, or however much is available, it gives you a good idea of the general sentiment around the company and how that's evolved over time. And a price to sales ratio can also change if a company becomes more efficient. So their operating margins increase because then each dollar of sales is much more valuable. But price to sales can also increase if the company just becomes more favored by the market. So we can see it's kind of been a downward trend. They were at about 3x multiple, 2.85x, about 5 years ago. They came down quite a lot and went down significantly in early 2020, as of many companies did. We're even at about half of their sales. And they've kind of rebounded since then. You can see about a few months ago, or late 2021, about 1.5 times sales, but now just about 1 time sales, a little bit above that. So historically speaking, does seem to be a pretty low price to sales multiple, especially when you look at here, how it was much higher. Which is interesting because when we look at their financials, we'll see that despite that, or I can even give you a quick look here, the company's fundamentals have improved pretty significantly, I would say, over that time period. So to me, it doesn't really make sense why the price to sales ratio has gone down. Because if we look at operating margins here, operating margins have gone up pretty much every year, and they're now at about 15%, when in 2017, pretty similar, about 14%. But in these years here, it was much lower. And sales have also significantly increased. We can see when they had about the 3 times price to sales multiple, they had under 600 million. That's now grown to 920 million. And they've had pretty much a double-digit compound growth rate in their sales throughout all these years. And even going 2020 to 2021, a pretty significant jump there, 21%. And even their operating margins increased. So later I'll explain why that happened. But we'll go back to the valuation multiples here. And the other one I like to look at is the enterprise value to unlevered free cash flow, because when I do a discounted cash flow model, I look at unlevered free cash flow. That's basically what we project. So this multiple you're looking here can kind of be a proxy for the terminal value. And again, pretty similar story to the price to sales multiple. It's gone down quite a lot and is currently quite historically low, only about 13.8x. And you are going to see more fluctuations in this because free cash flow does tend to fluctuate depending on whatever the company's doing and how profitable they may be one year versus another and what the market expects. But there is a pretty clear downward trend here going back as far as we can. Okay, so now let's actually jump more into the financial statements here. So we can start with the income statement, and I'll extend this back so we can get as many years as financial data as we need here. So the one thing that really stood out to me initially was, as I already pointed out, the growth rate in sales, especially in the past year. 21% is quite significant. And based on what I could tell, it seemed like part of this increase was they were able to increase their average unit selling price. So they're able to raise prices, even raise prices higher than to offset basically the cost increases that they had from whether that was a supply chain issue, partly also the labor shortage, all the various shortages that the economy is facing now. They actually raised their prices in excess of those cost increases. So that's why you can see their margin actually improved in the past year, 14.5% to 15%. Now, I like to look at operating margin because this gets used in the discounted cash flow model. And as you can see, it was a pretty similar increase in their gross margins. That went up as well. So it's a pretty easy business to understand. We can see gross margins kind of been in that 36, 37% range, and then 37% last year, whereas operating margins have pretty much been increasing. And I wouldn't necessarily project this increase to continue. For example, I wouldn't say in 5 years' time they'd be at 20% operating margin. I think that's a bit optimistic. So I think part of this increase is just because they were able to make the company more efficient, right? Because they're able to keep these costs here, the selling, general, and admin expenses, to a minimum as they increase their sales, they open new stores. And that's part of the reason why I think you see that there. And then also kind of this jump from 2020 to 2021 was because of that price raise that I talked about. So we can move on to the balance sheet here. Now, they are a retailer, so we have to be mindful of how they use debt, because a company that has excessive debt could really face financial trouble, especially if it's a retailer. So we have to understand how they're financing these retail locations they have. And we can clearly see the big item on the liability side is what's called capital leases. So there are two kinds of leases in the accounting world, really. There's capital and there's operating leases. And a lease can be either one depending on the lease terms, such as how long the lease is for in relation to the actual asset that's being leased, that asset's useful life, so it's economic useful life, how close the present value of the future lease payments are to the actual fair value of the asset itself, and various other tests. It's all a little bit complex, and it's, kind of a more advanced accounting topic that I don't really want to get into. But in short, what you need to know is that a capital lease is one that gets recognized as debt, because it is, in essence, it is debt. You're committing to pay a certain amount of money over a period of time to obtain economic benefits in the form of the use of the asset that you're leasing. Whereas an operating lease just shows up as an expense item on the income statement. So before 2019, which is why on the screen you only see this go back to 2019, this accounting standard did not exist. And it kind of came into effect then. And that's why you see a lot of companies, if they have larger amounts of debt, or you see this capital lease item, that's why. So an operating lease, those just continue to get expensed on the balance sheet, or on the income statement rather. And I'll show you the actual, what the accounting treatment is on the balance sheet here. So scroll down, you can see here's the lease liability. So $284 million as of, I think this is December 31st, 2021. And the offsetting asset to this is the right of use asset. So it's two things. You recognize an asset, the right of use asset, and then also the liability, which is this lease liability. So that's really how they're financing these properties, is they sign leases with the landlords so they can set up their locations in what they determine to be a good retail spot, because it's probably close to customers. And then this is how the accounting looks like. Okay, so lastly, we can move to the statement of cash flows. So clearly there's been an improvement in this company's cash flows, which if we go back to the actual stock price to see how it's performed, if we go back 5 years, the company has actually lost value over those 5 years, which to me seems interesting because again, if we go back to the cash flow statement, we can see 5 years ago, they're doing 92 million in cash from operations, and then about 25. So you can call that about 65 in free cash flow, and then 156 million in cash from operations, and only 20 in capital expenditures. So about 136 million in free cash flow there. If you define free cash flow as just cash from operations minus your capital expenditures. And the company's market cap is it's under $1 billion. So you're paying under $1 billion for a company that's doing $130 million in free cash flow, and that amount is actually growing. So if you're a typical value investor, that's going to strike you as interesting because that's a pretty low price. If you view companies as just cash generating machines, and when you're looking for something to invest in, it's like you're at the mall, you're looking at the price tags, which is just how much cash flow can I buy and at what's the best price I can buy cash flow for. This company would definitely stand out to you. And then in terms of how they use their cash flow, you can see they do make some acquisitions. So they made a larger acquisition here. I believe this was Endy, which is kind of their e-commerce brand. And then they made one in the past year, pretty recently, which is Hush, which I don't think that's an e-commerce brand, but it is kind of a separate brand that sells, sleeping related products. So they acquired them for 23 million. And then if we continue to scroll down, it doesn't look like they're paying any dividends. Or here we go, common dividends. So they do pay dividends here. So that's how they use some of their cash flow. And we can see there's no real pattern in their repurchases of common stock. So they're not currently, at least, using their cash flow to buy back their shares. So really how they're using their cash flow is the occasional acquisition, some capital expenditures as well. They're paying some dividends, and the rest they're probably retaining in the business and using it to keep it functioning and operating. And we can see, actually, we can go to the income statement to get a good idea of what the pattern in their shares outstanding has been. Because we want to take note of this because it'll let us know, are they issuing shares or are they buying back shares? Because we want to know if our ownership is being diluted or if it's, increasing. And it seems like it's been decreasing a bit over the years, but not by a whole lot. It was increasing up until this point, and then it's kind of been flat then. So when we do the DCF model, we can basically project that there will either be no change in the shares outstanding or maybe a small decline. Okay, so now let's talk about some industry trends for a bit. So this is the part of the video where we try to add some additional context to the numbers that we're seeing on screen and try to understand what trends are taking place in this industry. Now, we have to recognize as retail investors, we're not industry experts unless you personally work for a competitor or maybe you even work in the Sleep Country corporate office, which seems unlikely to me. But if that's not the case, then it is kind of unlikely that you'll be able to accurately foresee and forecast any future trends in this particular industry. So you have to understand you're not an industry expert, but what you can do is you can learn a bit about the industry to try and add additional context to the numbers you're seeing to help you make sense of them. And this is also part of the reason why when we invest, we try to invest with a margin of safety and have more conservative assumptions, because that helps compensate us for additional risk that we're assuming when we invest our money into an industry that we have limited knowledge of. Now, again, that being said, that doesn't mean we can't at least gain a general understanding of the industry, maybe learn some basics, because even having a basic level understanding might be good enough to help you decide if this investment is worth looking into or if it's something you should be avoiding. So what I've done here is pulled up basically some pretty simple facts about the mattress industry. So what you can see here is that the average mattress is going to last between 7 and 10 years. So unfortunately, this is a business where if you satisfy your customer, they're not going to come back to you. At least they're not going to come back to you for a while, maybe not 8, 9, 10 years down the line. A happy customer is a customer that you don't see for a while. So you have to recognize that and understand what implications that has on the business and the customer experience that they try and offer, right? Customer satisfaction becomes very, very important. Now, here's another quick, interesting tidbit about the mattress shopping industry and what trends are taking place that I was able to find. So it's by Bedtimes Magazine. I'm going to assume this is a reputable brand here. And it kind of shows you the difference in various age groups over here and also the shopping methods. So if we look here, it compares the results of 2020 to the results of 2016. So the number of people that would consider purchasing a mattress online, so through an e-commerce outlet, was 27% in 2016, 47% in 2020. But that's still vastly outweighed by the amount of people who would rather purchase it in a brick and mortar location. So to me, that does kind of bode well for Sleep Country. They do have an e-commerce presence with with their regular Sleep Country brand and then also with Endy. But still most of it is taking place in brick and mortar locations. That's really it's still very important for the industry, right? Having a convenient location near a lot of people is going to be very important. Real estate is something that's super important. And if we look over here, we can see that pretty much the younger generations are going to be more inclined to be purchasing online. So the yellow would represent 18 to 35-year-olds. That's kind of your younger cohort. 71% of them said they would consider purchasing online, but still 86% would rather go into the brick and mortar location. So from this, we can really derive two key trends. One is that most people would still rather purchase their mattress in a brick and mortar location, so a retail outlet. And the amount of people that would purchase it online does seem to be increasing, especially in these younger cohorts. And as they age, I don't think their shopping patterns would change. So that is useful information for us when you're looking at Sleep Country as a potential investment. Now, a competitor you may have heard in the mattress industry is a company called Casper. So Casper is what was called a D2C company or direct consumer. So they claim to be the new kid on the block that was going to completely revolutionize mattress shopping by selling mattresses directly to customers. So eliminating the need for retailers and having an extremely generous refund policy where they would give you 100 days to test the mattress to see if you liked it before committing to buy it. However, Casper has really, over the years, they've come to be known as a bit of a failure. And they actually are a publicly traded company, so we can look at how they've performed. And they've been kind of a failure because they really haven't made a whole lot of money. And since they've gone public, they actually, I believe, their stock has gone down a pretty substantial amount there. So they are kind of known as a failure, even though they are still a company that's trying to figure things out. But the problem is the business has been moving gradually back into physical retail. As we can see with the article that I had pulled up earlier, they actually signed a partnership with Sleep Country to sell their mattresses in their stores, which is interesting because when Casper was, kind of coming up and they were claiming to say that we don't need retailers, right? Direct consumer is the way to go with mattress shopping. But now, despite that, they're actually, partnering with the very company that they were trying to disrupt. So this whole the point of this whole monologue that I'm trying to say is just to show you some evidence to prove that the traditional mattress retailer business model, the one that Sleep Country has, the one that was trying to be disrupted by Casper, even with millions of dollars of venture capital money and loads of free media marketing because of all this attention that Casper got, they still couldn't quite do it. So to me, that shows pretty strong evidence that in retail locations is really what customers prefer when it comes to mattress shopping, which to me does bode well for Sleep Country into the long term, into the very long term, 5-10 years, because it's a company that is always going to need physical retail locations. Okay, so the last piece of the puzzle is to do an actual discounted cash flow valuation to understand what kind of value this company does offer. So we'll start with the sales growth rate assumption. So I assumed a 5% sales growth rate from 2022 all the way to 2028. And then kind of the terminal value from 2028 onwards is going to be 1%. And that's kind of the perpetual growth rate of the company. That's 1% as the company approaches maturity. So this is a rather conservative estimate, especially when you look at what the company has done historically. They've never even grown sales at 5%. It's pretty much been 15, 20. I believe the lowest was about 6% year over year sales growth. So 5% may seem excessively low. However, to me, it doesn't seem too low. It's just conservative because what this kind of implies is about a 2% growth per year in store locations, which is about on par with what they've historically done. Remember, growth in store locations is going to depend a lot on whether they can find good locations and the economy overall, because they're not going to open stores if they don't think they can achieve decent sales at those stores. And then it also assumes about between a 1 to 3% growth rate in same store sales revenue, or same store sales essentially, which again, that's pretty reasonable when you look at what it's been historically. And if you look at what the company themselves is actually projecting, it's not going to be a huge jump in same store sales revenue. You would see a huge jump in the last few years because you're comparing a lockdown year to, a year where people weren't as concerned about the lockdowns and what was going on in the world. And then there's also what else makes up that 5% would be any added benefit they get from e-commerce sales. Now you have to keep in mind that e-commerce sales may actually cannibalize some of their sales, right? Which essentially means sales that would have taken place in store are just taking place online in the e-commerce stores, and it's not generating new additional sales. It's just a change in the channel that the sale takes place on. So that's why I kind of went with 5%, because I didn't want to get too aggressive and assume that a company like this is going to have, explosive growth in some of these new brands that they've brought on, right? So ND and Hush, for example, although ND is a great example of a brand that does appear to be doing pretty strong. Essentially, if we're having a conservative sales estimate, we can chalk it up to 2% growth in store locations, somewhere between 1 to 3% in same store sales. And then to make up the rest of the 5% could just be any additional benefit from e-commerce. So the growth in the ND brand, for example, if, that ends up materializing. So to me, that's just something that's just more conservative. Now, I did go with 15% with the operating margin and didn't change that at all throughout the remaining years. So the reason I did that was because I do think that this is a company, like pretty much all companies, it's going to be affected by the various shortages we're seeing in the economy, right? So this would be the labor shortage. So that's going to increase their labor costs, which would lower their operating margins. You may also see a supply shortage because you're kind of seeing supply chain shortages throughout the entire economy, which may make it harder for them to get some of their materials or to get product to actually sell at their locations. But I do think that they'll be able to offset that with higher costs. And reason being is because we saw them do that in 2021, where they actually offset their costs higher than, or they raised their prices higher than what their costs were. So that's what increased their margin. So what I'm assuming here by saying that this percentage isn't going to change at all is that whatever cost increases they have, they will be able to offset those with raises to their prices, which again, that may be the case, maybe not. I'm not really an expert in this industry, so I do have to make an assumption here. To me, it strikes me as reasonable. But again, you do have to build in a little bit of assumptions when you make these models, because you can't accurately predict everything that will happen. And then there's all these other assumptions like the taxes, which I just took their historical tax rate. Capital expenditures, again, just went off of what it's been in the past and assumed it'll grow a little bit. And then similar with depreciation and amortization costs. So we get our flow of free cash flow to firm, which is calculated here, as well as our terminal value. We discount that to get essentially the enterprise value. So we discount all of these future cash flows to the present. So we get our enterprise value. I had 50 million in cash. So that's the estimate for 2028, 600 million in debt. So that includes all of their capital lease obligations, all of their short-term and long-term debt. Again, that's really just an estimate. So then we get a value of equity here of about 1.1 billion here. And then their shares outstanding, I assumed it's going to decrease a little bit. So about 0.2% a year, pretty much in line with what we saw when we looked at the income statement. So this gives us a fair value per share of about $30. And as of making this video, the current share price is $25. So with these assumptions that I have in, if you believe these assumptions will materialize, then yes, Sleep Country is slightly undervalued. And you could expect about a 12.4% annual return, again, if these assumptions materialize. Now, you may be wondering why this return is so high when the company is not that undervalued. I mean, we're only saying that The current price is 85% of our calculated fair value. They do actually have a pretty high cost of capital, about 10%, which I've done a few of these analysis videos now. Cost of capital is usually going to be in the range of 6 to 8%. So 10.5% is quite high. And the reason being is they have a quite high beta. So the stock in itself is actually volatile. Now, not everyone agrees with beta as a good metric to use when you're trying to calculate cost of capital, but I am kind of going with the finance textbook method here, which uses the capital asset pricing model. I did a whole video on this, kind of explaining each step in the DCF process if you guys want to check that out. But I will link this spreadsheet in the description of this video in case anyone wants to take a look and look at what I did more in depth. But at a 12.5% estimated annual return for what I think are pretty conservative assumptions, to me, this is a company that actually does intrigue me a little bit. For example, we can increase the sales growth rates here. Let's say if we put this at 8% and we put this one at 8% and leave everything else at 5%, that pretty much gives us a whole other percentage point increase in our projected investment return. And really what I aim for is 15%. That's really the sweet spot for me, because historically you can get 10% investing in index funds over long periods of time. If you're going to invest in an individual company, you need that added measure of safety, right? Or that added benefit of taking on the additional risk of investing in an individual company that is subject to just micro level influences in the market and not just the macro level, which is what you get when you invest in index funds. But let's say, they do even better than that. They do 10% revenue growth, 10% revenue growth, and then maybe in the future, they do 6% instead of 5%. Still not quite at 15%. So we do have to make our assumptions much more optimistic in order to get to a place where, the company is worth looking into more. And personally, at this rate, I wouldn't be as interested in the company. So if we have these assumptions here, 10% revenue growth, and then 7.5% up until 2028, then yeah, the company's looking pretty good, 15.5% annual return. But to me, that seems a little bit optimistic. It's not out of the question, but it seems too optimistic. And I wouldn't really want to stake, a good chunk of, my investment portfolio in those assumptions materializing. Because again, if you look historically, what you can really expect is about 2% growth in store locations, 1 to 3% growth in same store sales, and maybe some additional benefit from the growth in their e-commerce brands. Anything more than that, and to me, it seems like you're really hoping for a very optimistic scenario there. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening to my thoughts. I hope you did enjoy it. If you did, then please leave a like and subscribe if you're new to my channel and you like this type of content. And I'll see you in the next video.